Hey everyone, it's Denise Donahue, the Mortgage Nerd, and this is a quick look behind the curtain about all things mortgage interest rates, how they work, and how do you read them. So the first thing I want to do is just explain to you the difference between what interest rates look like in the old days versus what they look like now. And so this slide is to show you that basically prior to the housing crash, mortgage lenders could charge whatever they wanted for interest rates. In fact, there was a lot of money that they made in the interest rates, things called the back end points and things like that. That was when there was stated income loans. And basically after the housing crash, the government stepped in and got involved and said, okay, no more of what we call these subprime mortgage loans. We have to verify assets, income, and we are going to make mortgage lenders look at these 30 different adjustments when it comes into interest rates. So it's kind of more of like an insurance quote. If you've ever gotten health insurance or life insurance, we're going to look at things like loan amount and term and the purpose of this, if it's a purchase or a refi, what state, if you're getting gifts, reserves. All these adjustments that you see here are things that we look at as a mortgage lender. So sometimes I have clients call me and they say, well, I have an 800 FICO score and putting 20% down. What's your best rate? But I don't have a total scorecard in order to truly tell you the interest rate. So if you call a mortgage lender, they're going to quote you the lowest rate possible. Duh, that's what they're going to do because you're only giving them limited information. So just know it's really important to have all of this, and that is why ultimately a lender's asking for it, is so they can properly quote you an interest rate. Now, what many people don't know is that a lot of this stuff is public information, like these adjustments. So if you go online to Google and you type in Fannie Mae, I'm going to do it with you, Fannie Mae LLPA, which stands for Loan Level Pricing Adjustment, you're going to see it pulled up here where you can actually view this yourself and look at, okay, what are the adjustments? Well, this is the first one I go to because it's the most common. If you have a 740 or above FICO score, that's going to put you in the top tier. So what that means is it doesn't matter if you have an 800 or a 740. There's no brownie points for the 800. It's going to be the top tier. The second tier is going to be anything between a 720 and a 739. The third tier is listed here. Fourth tier, fifth tier, you get the point. And then in these columns here, this is all based on the amount of the home that you are financing with a mortgage loan. So for example, 20% down would mean that you're financing 80% of the home because you supplied the 20% of a down payment. And what you can see is the adjustment is right here. There's still going to be a 0.5 adjustment on the interest rate, even if you have an 800 FICO score and you're putting 20% down. This is a change that was made just a couple years ago. But if you put 40% down and you have an 800 FICO score, you're going to get the best rate possible. It just doesn't make sense to put 40% down. That's a lot of money to tie into an asset that doesn't have any kind of compound interest in it. In fact, if you have a second tier credit score, you're still not going to get any kind of rate adjustment. So that's a change that you might not have seen. If you have 5% down, there's going to be an adjustment. Look what happens if you're in the second credit tier. That adjustment doubles. And then what if you have a 700 FICO score? That adjustment goes to 1 full basis point. So these are all things that are already public information that you can Google and you can see, well, what if you're buying this as a second home or an investment property? Or what if you're refinancing? You can go to Google and find all of this directly on the LLPA chart. But the question becomes, how does mortgage lenders make their interest rate or make their profit? Well, you can see that by there are a pool of investors that get together, so a bunch of humans that get together and they buy what are called mortgage-backed securities or mortgage bonds. So let's say you and 10 of your friends get together and you all take $100 and you put it in this jar and you say, okay, I want to buy mortgage bonds. You're going to buy those bonds or that jar of jelly beans, which are the mortgages, from Fannie Mae, Freddie Mac, or Ginnie Mae. And let's say Fannie Mae is going to give you a 4% rate of return on your jar. Well, then what does Fannie and Freddie do? They're then going to take that and lend it to the big banks. So the Chases, the Wells Fargos, the Bank of Americas, And if they're paying you 4%, they're going to add 0.25. And so now they're charging the banks 4.25, which means they're making 0.25 on the money. Then the Chase and the Wells Fargo are going to add, this is just an example, another 0.25, and therefore you end up paying 4.5% because 0.25 of that is going to Chase, and then another 0.25 is going to Fannie and Freddie, and ultimately the money came from mortgage-backed investors. Well, that is what we do as your mortgage lender, is we can shop all the big banks, and ultimately we're not really shopping the interest rate for you, we're shopping which bank is going to ultimately service the loan for you at the cheapest rate. So once I shop all the big banks, I actually show you your rate board. Yes, there's like no lenders do that, but you have a lot more rate options available to you than just one or two rates. And so this is what can be a little bit confusing. This is an example of what a rate board actually looks like. In this particular client situation, after analyzing their scorecard with those 30 adjustments, along with the bond market, they have an interest rate available to them as low as 2.375 and as high as 4.25. Literally every single rate on this rate board is an option available to you. But typically what we see on advertisements and on loan and marketing is the lowest rate option available. So in this case, the 2.375, and it's in really big, bold font. And then below that is a tiny paragraph with really small font that nobody ever reads. And that's what's in this column here. So there's a cost for that interest rate. This is called discount points or prepaid interest. So literally this client would have to spend $8,900 just in discount points to get this interest rate. And that's what nobody reads. It's that fine print. As the interest rate goes up, the cost goes down until you get to these other rates like this 3.375 and the 3.2. If you notice, it's really small on the screen, but there's a negative number here. And those are what are called negative points, or what marketers call a lender incentive. That money goes as a credit towards your closing costs to offset the cost. Now they call it a lender incentive. It's not like the lender's just giving it to you just to be nice. It is because you're opting for a higher interest rate. And all of these options are available to you, but loan officers don't share this with you, in part because it's so overwhelming and it's confusing and it makes your head spin. So what we do is we show you your rate board, and then ultimately we're going to show you what's called a certified mortgage analysis, where we will pick 4 of your interest rate options that seem to make the most sense, and we'll put them side by side. And we'll analyze the monthly payment for each one, and then we'll also analyze the total funds for closing for each one. Now, like I just mentioned, the funds for closing is identical. It's your down payment, it's your closing costs, it's the deposit for your escrow account if you have one, plus the prepaid interest. So that's the only reason why this 2.875 requires more to closing, is because there are discount points or that interest rate costs more money. And the only way to know if that is a good financial decision is to run the numbers, because we are programmed as consumers to just assume that the lowest interest rate is the smartest financial decision. But is it? You have to run the break even. And that's what this chart tells us here. Every single one of our clients gets this analysis. In this instance, the client said that they thought they were going to be in the home for 120 months or 10 years. So we ran the analysis. Here's your rate of return on the investment, on that prepaid interest. Does that make the most sense? Or is there credit cards that you should wipe out instead? Because if you look at the funds to closing here is $53,647, or it is $3,400 more expensive to get this interest rate. So the $3,400 upfront investment for that rate yielded this client a rate of return of $3,160. Is that $3,400 best used put into the mortgage or paying off other debt or other items that might be at a higher rate of return than this? Or should you invest it? Is the compound interest that you could get invested into a, let's say, a brokerage account, into a mutual fund, is that compound interest that you could earn, or the interest rate, higher than the mortgage rate? And that would mean that your money is better spent invested than it is on the mortgage. But nobody tells us this stuff. Not even oftentimes mortgage people tell us this stuff. And that is why I'm here to tell you it today. Lastly, I will just end that as a mortgage professional and as a certified mortgage planner, we are always watching the bond market, because the price of bonds is what causes what investors get paid from that jelly bar, that jar that we sold to them. The mortgage bond price is what causes that price to fluctuate. So if you remember back in this chart here, what this is based off of is essentially how the bond market is performing. So it's so important that you work with a mortgage advisor. It's so important that you're analyzing what does the change in the rate really do to the monthly payment, and how much does it cost me for that rate. Those are all things that myself and the Mortgage Nerds do here for you, and we're super transparent. We're going to show you the rate board. We're going to shop all the lenders while providing really good customer service. That is our passion. So thanks for tuning in. If you have any questions, you can go to our website and book a phone appointment right online. Take care.